It's a pretty interesting article in Money Magazine, the CNN Money website, that talked about the pros and cons of fixed income annuity or fixed index annuities. A little bit more geared against them, and I want to chat with you on this because I think it's actually pretty important, especially when given the articles I was looking at yesterday on these products. So let's dive right into this. As always, if you like what you see here, don't forget to subscribe down below. Thumbs up always help me, and comments as well help me with the YouTube algorithm. And let's see what we got here. There we go. Am I on? Okay, sweet. All right, so this is an article that was dated back in September of 2018 from Money Magazine. The famously tricky investment product just got easier to sell. Here's what to look out for. So this certified financial planner out of Ohio noticed that on the TV, a lot of ads were coming on, a surge for commercials of annuities. Complex insurance products that offer certain guarantees for investors, often at a high price. He watched them warily, hoping that the would-be buyers actively weighed the pros and cons rather than simply succumbing to the sales pitch. The timing was no coincidence. In June, an appellate court vacated the so-called fiduciary rule, killing an Obama-era regulation designed to protect retirement savers from conflicted advice. Because salesmen selling commission-based products are conflicted and registered investment advisors selling fee-based products are not, is what the industry would have you believe. The regulation, which many Wall Street firms oppose, had created uncertainty for sellers of fixed index annuities, and particularly by challenging their distribution model. When the regulatory cloud was lifted, it was like the dam broke, says this CFP out of Ohio. Sales of fixed index annuities have hit a record of $17.6 billion in the second quarter, which is 17% higher than it was a year previously. Annuities come in several flavors, but all involve guarantees from insurance companies, and a contract will ensure, for example, that you receive your guaranteed income for life or that your principal will never decline. Unlike their more complex cousin, the variable annuities, fixed index annuities do not contain underlying mutual fund investments. I'm not sure why they say variable annuities are more complex. I don't think that to be true at all. Instead, your principal rises or falls according to a formula that's based on the underlying index, the Standard & Poor's 500, for example. Today's market environment has also boosted their appeal. Annuity payouts and other features fluctuate with interest rates, which have risen this year. What's more, the bull market has entered its ninth year, and many investors, particularly those close to retirement, may be drawn to the promise of holding on to their nest eggs no matter what happens in the market. I can attest to that. I was talking to a guy yesterday. He got good to go on his wife's pension, his own Social Security, her Social Security, their income, no debt. And he's nervous. He's like, I got 2 years left of retirement, Josh. I want to make sure I don't get hit like 2008. And I was saying, you're going to be fine. But he's looking at annuities. I mean, if it makes you sleep at night, I got no problem with that. Equity markets have been running hot for so long. Clients are concerned about a downturn and looking for protection, says some guy over at PNC Investments. Still, shockingly, not all financial advisors are pleased. Many worry that fixed index annuities' high fees and tepid returns mean that in the long run, few index annuity investors will end up better off than they would have been if they just use a globally diversified portfolio of stocks and bonds. I want to jump down here to a couple of things because my man David Blanchett over at Morningstar, who I'm a huge fan of, compared the index annuity versus over 30 years versus a stimulated portfolio of 100% stocks and 50-50 stocks and bonds. So if you put $100,000 today in a fixed index annuity with a 0% floor and a 9% ceiling, after 30 years, you'd have a portfolio worth about $210,000 according to one simulation that he ran. However, you'd have $253,000 if you invested in a balanced portfolio of 50-50 stocks and bonds, and you'd have $415,000 if you just did all stocks. Now, that sounds like the fixed index annuities are going to give you worse returns, but the problem, two things that jumps out at me is, one, is Blanchett using fees on the naked portfolios, i.e. the ones that have no insurance protection? I don't know. My presumption is no, but I just have no idea because the article doesn't state. So you can't make a comparison on a fixed annuity fixed index annuity to a naked portfolio of stocks and bonds, because if someone is managing it, like these guys were referring to in this article, for a fee, you got to take that fee off the performance. And if you're not doing that, it's completely, it's just not a legitimate comparison, not in the least. Secondly, if a fixed index annuity purveyor is offering that you're going to get stock-like return on your fixed index annuity, you need to find a new insurance guy, because I'm going to read you directly from the Roger Ibbotson article, which kind of talks about fixed income annuities and index annuities in a favorable light. Now, Ibbotson is well known. We all know who Ibbotson is in the industry. He's been around for a long time. He's a professor emeritus at Yale for finance. So Ibbotson's got chops that go back many, many, many years. And so we all kind of furrowed our brows, so to speak, when he talked about this, the benefits of fixed index annuities. But he says it very clearly. A fixed index annuity may be an attractive alternative to traditional fixed income options like bonds. And then he says fixed income annuities help control financial market risk and mitigate longevity risk. And that's 100% right. And so, I mean, Ibbotson is saying, look, you're not going to get stock-like returns on fixed index annuities. You're going to get bond-like returns probably. And over his research, the bond-like returns are actually quite favorable relative to stock market or relative to the bonds themselves. But that's what you're looking for. That if that's what you're looking for, some protection against downside risk. And on top of that, you want a guarantee of income you cannot live. A fixed index annuity might be appropriate for you. But don't compare fixed income annuities to index annuities to stocks, because they're two completely different things. And so, secondly, if you got a guy who's saying, "Oh man, you're going to got $415,000 invested with me. I only charge 1% annually fee. 1% annual fee. If not, how are you comparing this to apples to apples? You're not. You're comparing a fee-heavy account with fixed index annuities with a naked account, but that doesn't include your own commission. And so that bothers me, actually. All right. And then again, fixed index annuities also give you the chance to at least earn a pretty good income that you can't outlive. Now, I will tell you how it typically works. You dump $100,000 in an annuity. You're guaranteed to get, we'll say, $10,000 a year off that after a certain holding time, usually 10 years. So you say, okay, I'm going to give you $100,000 insurance company, 10 years. I'm going to collect $5,000 a year off that. So they are guaranteeing you a doubling of your income as long as you don't touch the money within those 5 years. Now, the thing is, with that doubling of the income, if the portfolio continues to perform, you might see an increase in that income. And if you die before the portfolio is exhausted, you do leave a residual to heirs. And the residual might be more than what you put in. I don't think that'll happen, but there is a residual income that these things can offer. Unlike a single premium immediate annuity, you literally say, here's an insurance company, here's $100,000. You're going to give me $6,000 a year for the rest of my life. And if I die tomorrow, then it's gone. With the fixed index annuities, you're not quite getting the same payout as a single premium immediate annuity today, but you're getting some of the better benefits is that there is some residual value potentially. There is some ability to access principal potentially, and it could have an increasing income stream as well. So the point about this, if you're looking at a way to protect your downside and you're okay with market-like bond market-like returns, and you're locking up your money for quite some time, a fixed index annuity, it absolutely could be for you, without question. Ibbotson, my man Michael Edison, they all talk about the benefit of fixed index annuities are that they could give you bond-like or a little bit better than bond-like returns with not any risk at all to your principal, with a couple factors. A, they're not cheap, and B, there is some surrender charges in there for sure. But if you don't care about the markets, and then the market, absolutely naked market is the way to go. C, if a guy is trying to sell you on the idea of market-like upside with downside risk, there is no such animal out there. To get markets like returns, you have to be in the market naked. That's all there is to it. There's no other way around this. We've tried this in every different way to Sunday and various shenanigan portfolios, and it doesn't work. If you want market-like returns, you got to be in the market. You got to be naked in the market. No insurance wrapper, no portfolio insurance, no hedging. You have to have market risk. That's all there is to it. So if you go in there fully understanding how the annuity works, and they'll say, ask her how much it costs. Yeah, I agree with that. Ask how much it costs, the fees, how much the guy gets paid. Agree with that too. But also ask your registered investment advisor who's only fee-based how much he charges. And don't just say, I charge 1%. How much is that in dollars, dude? Tell me in dollar bills how much that is. Make him tell you, because it's so easy to say, I only charge 1%. That's nothing. Well, if I got $500,000 and you're charging 1%, that's $5,000 a year on top of whatever funds you put me into. So, as always, like what you see here, please subscribe down below. Comments, thumbs up, help me a lot. Share the video if you want. If you find value in what I do here at Heritage Wealth Planning and you want to support the podcast or the YouTube channel, go to my website at heritagewealthplanning.com. You'll see on the bottom there'll be a little donate button. I'll be happy to accept your donation of $5, $50, $5 million, whatever you want to do. No gift tax included unless you give me more than, was it 5.5 million? No, I think it's 10 million. So if you want to give me more than 10 million, you will pay a gift tax. I won't, but you will. So just keep that in your mind. But anything less than roughly 10 million, no gift tax. You do got to file a gift tax 709 form, IRS form 709, telling the IRS you gave me that money, but there's no gift tax. Hey, don't forget, we'll see you guys next time. Thanks, now.